October 3rd was a rough day for the Indian stock market, with a massive 9.6 trillion rupees wiped out. But what triggered such a drastic fall? Let's break it down. First up, Middle East tensions. Iran launched missile attacks at Israel, sparking fears of oil supply disruptions. Now, oil prices shot up, crossing $75 a barrel, putting added pressure on India's economy, which heavily relies on oil imports. Next, it hit the big companies hard. Stocks like Reliance and HDFC Bank took a hit, and the Nifty oil and gas index nosedived. India's fear gauge, India VIX, spiked by 8.9%, showing just how nervous the markets were. Then there is the SEBI factor. New, stricter rules on futures and options trading dampened market sentiment even more. Add to that the China factor, where rising Chinese stocks drew 15,370 crore rupees out of Indian markets, leading to further pressure. So what's next? As the Israel-Iran conflict escalates and oil prices continue to rise, where should you invest your money? Let's dive into some options. Number 1, large cap stocks. Stick to quality large cap stocks in pharma, FMCG and IT. These sectors are typically more stable and are not as heavily impacted by rising oil prices. Pharma and FMCG. Now these are your defensive plays, long-term stable investments with growth potential even in turbulent times. Number 3 is commodity-related stocks. Yes, sectors like cement might feel some heat from rising oil prices, but they could present long-term opportunities once the dust settles. IT sector, the digital-first world isn't slowing down and IT stocks are well positioned for future growth. Then, consider holding up to 15% of your portfolio in cash and gold for stability during these volatile times. Steer clear of overvalued small and mid-cap stocks. Focus on quality in this space. It is important to do a thorough evaluation before jumping in. Avoid oil-linked sectors. Rising oil prices don't bode well for industries like oil marketing, aviation, paints and tires. It's best to steer clear for now. Short-term strategy, in the near term, volatility is expected, so using a sell on rise approach might be wise. Keep an eye out for opportunities to cash in on spikes. That is the lowdown on why the markets took a dive and where to look out for your next investment. Stay smart, stay patient and keep your long-term goals in mind. Like this video, follow and subscribe to Business Standard.